There is a lot of craziness going on in the world right now. If you're looking at tensions between countries, inflation absolutely wrecking your buying power. Cryptos are down 50% over the last 3 months. There's lots of volatility in the stock market. If you're like me and you're worried about protecting your wealth, should you be looking at gold as a possible investment option? And if you do decide to go with gold, how should you invest in it? Stick around because today I'll be talking with one of the biggest names in the gold space. He is the former CEO of Gold Corp and played a huge role in setting up their $32 billion merger with Newmont. He has been building successful mining companies for over 3 decades. Now he is the chairman and CEO of Gold Royalty Corp. His name is David Garofalo. David, thank you so much for joining me today.
I'm delighted to be here. Thank you for hosting.
Absolutely. Now, I am super excited to hear about the gold royalty business model and how all of that works. But first, we got to talk about gold. The government is going to be raising interest rates. Do you think this will have a huge impact on the price?
Well, if anything, I think it'll continue to have a positive impact on the gold price because even though nominal rates might be going up marginally, real rates are still going decidedly into negative territory. And what's driving that is runaway inflation. And the headline numbers at 40-year highs of about 7%, but that severely understates where inflation really is. Because if you're putting food in your stomach, fuel in your car, a roof over your head, I can tell you your inflation rate is well north of 7%. It's deep into double digit territory. So it really doesn't matter that nominal rates are going up a quarter point here, a quarter point there, because inflation's been unleashed. It's going to continue to rise, and it's going to drive real interest rates far further into negative territory, which will provide a strong foundation for a large run in the gold price, in my view.
Yeah, if we look at the last 6 rate hikes, gold has gone up on average 30%. Do you think it'll be around the same this time, or we could see a bigger push?
I think we're likely to push to $3,000 an ounce. And really, how I arrive at that is I look at how gold behaved in the last significant inflationary cycle, which is back in the 1970s. So we exited 1970s, 1979 with a new Federal Reserve Chair, Paul Volcker, who was determined to tame inflation, and he started to ratchet up interest rates. But gold ran for years after that because inflation was unleashed because of the oil crisis and because of money supply increases. And it took them years to tame inflation. So even as interest rates were going up nominally, they continued to go down in real terms, like we're experiencing right now. And gold didn't achieve its all-time peak, at least in nominal, in real dollars, until 1981, when it achieved $850 an ounce. You inflation that, adjust that to today's dollars, that's $3,000 an ounce. So we're nowhere near the cyclical high that we saw back in the last inflationary cycle. We still have quite a run here, and I think we're going to see gold running for at least several years.
I could definitely see that being the case as well. Now, if we look at the stock market, there's been a lot of volatility recently, and cryptos are getting absolutely hammered. Do you think people are already starting to flock to the safe haven assets?
Now, look, I think what really plays the gold's advantage is that it has physical properties. And I'm not trying to diss cryptocurrencies. Cryptocurrencies are here to stay. They're an integral part of the whole blockchain platform and how that's been introduced into the general economy to wring out costs and eliminate middlemen and whatnot. So I think it's going to introduce efficiencies to the market. And we need digital currencies in order to participate in the blockchain. So I think they're here to stay, but the valuations have gotten far ahead of themselves. And cryptocurrencies, unlike gold, don't have any scarcity factor. There is an infinite amount of cryptocurrency because anybody can introduce a cryptocurrency into the market to capture market share from the Bitcoin. And in fact, I think the central banks are going to domesticate digital currencies because there's no way they're going to let this Wild West continue, this volatility in a currency continue. I think they're going to essentially digitize their own currencies and capture the market share that Bitcoin and other cryptocurrencies have. So I think there's going to be flight of capital out of cryptocurrencies into gold because gold has physical properties, has been recognized, as a currency for 4 millennia. And I think that's the advantage it has over the digital currencies. Digital currencies are like any other fiat currency. They can be created at a whim. And we've seen what havoc that's wreaked in the general economy and the inflation cycle over the last decade, really since the last credit crisis. as we've seen exponential increases in money supply.
Oh, for sure. When I think of a good store of value, I think of a hard asset like gold. And when it comes to investing in gold, there's physical, but also some people might not understand the difference between a mining company and a royalty company. Can you talk about that?
Look, I think that goes to the question of how do you play the gold price most effectively? If you believe that gold is a strong asset class for you to invest in, and if you believe gold's going to continue to gallop upwards here in this inflationary cycle, you have to ask yourself how to best play it. And there's a few ways to do that. You can buy the physical gold product. You can buy a coin or a bar, and of course you have to store it, and the storage costs associated with that. And I think that's a great way to protect some of your capital. The other way to do it is to buy mining equities, the producers. They provide you leverage to the gold price because as gold price goes up X percent, their profitability should go up further than that, X plus percent, because of the leverage that it provides to their profitability. But of course, with mining producers, their cost structures are dynamic. They're not static. And so their margins could very well be squeezed by this inflationary cycle that we're experiencing. And that's why at this point in my career, I've spent 32 years building and operating, producing mines. I've run some of the largest mining companies in the world on the gold and base metal side. And the reason I position myself in a royalty company is I am concerned about what inflation is going to do to the operating and capital costs of the mining business. And what royalty companies provide is exposure to the gold price through the top line. In other words, we get a percentage of the revenue. We're not exposed to the cost structure of the mine. So what we do is provide capital to the producers, the explorers, the developers to help build their mines. And what we do is take a royalty back in return as a fixed percentage of the revenue they produce from their gold mines. So we're not exposed to their costs whatsoever, their margins. And so we provide leverage to the gold price and completely insulate our shareholders from cost inflation. And the other dynamic that we offer is exposure to exploration upside. So our royalties are not only on the existing deposits, but as the operators explore and expand their deposits geologically, we get a royalty on the expansion of the reserves and resources. So we get the best of all worlds: leverage the gold, leverage the exploration success, but complete insulation from operating capital cost inflation.
I can imagine eliminating risk factors would be super advantageous. I know a lot of the junior mining companies, risk is a huge consideration. So let me ask you, where are your royalties located? What part of the world, and how many do you have?
Well, we have a very significant and diversified portfolio of royalties. We own 191 royalties across the Americas, with 75% of the underlying value of our royalty portfolio in two jurisdictions, Nevada and Quebec, the two best gold mining jurisdictions in the world, as judged by the Fraser Institute, which is an economic think tank here in Canada, which evaluates and ranks jurisdictions globally based on mineral potential, low political risk, and low regulatory risk. And Quebec and Nevada perennially rank as number 1 and 2 in the world. They quite often jockey between each other. And so we have the majority of our portfolio there. Within those 191 royalties, we have 6 that are in production. And so they're generating cash flow for us today. But then beyond that, we have 180 other royalties at every stage in the life cycle of a mine, from early stage exploration through mine construction, through feasibility, pre-feasibility. So we have a lot of embedded growth within the portfolio. And also we have what we call a royalty generator model. We have a team in Nevada, we have a team in Quebec that generates their own royalty opportunities. And the way they do that is they stake exploration claims around existing mines, and then they farm the properties back to explorers and developers and take a royalty back when work is required on the ground. So it doesn't require any capital from us. It requires very little effort for us to actually stake these exploration claims, but gives us an organic pipeline of very low cost growth in terms of a royalty portfolio. In fact, we introduced a dividend this week for the first time. We only IPO'd in March, so it's remarkable after 9 months, given how quickly we've grown, that we've been able to already introduce a quarterly dividend of just under a 1% yield for our shareholders. And we think with the seven operations that are in construction right now, mines that are in construction right now, we're going to have dramatic growth in our cash flow in the next 3 to 5 years and beyond, which gives us the potential to look at expanding our dividend over time as well.
Wow, you guys are already paying a dividend. That is so cool. So if I can recap, just so I make sure I got it right, you have 6 companies that are already in production, you have 7 that are in construction, and then you have all of the exploration, junior miners as well. And because you guys are a royalty company, you take your revenue off the top line, so you don't have that risk of inflation eating away your profits, etc. One thing that I guess I don't understand is it possible for you to add more royalties, or are you pretty much maxed out at this point?
Well, we think there's still lots of scope for consolidation in the royalty space. And just to give you a sense of the landscape in the royalty business, there's 3 very large cap companies in the royalty space. Franco-Nevada, the biggest; Wheaton Precious Metals, second biggest; and then Royal Gold. And those are large cap companies, 20 plus $1 billion market cap, give or take. And then there's a whole large fragmented universe of about $1 billion market cap companies, and far less than that, small. And there's probably 10 to 12 of those. So there's certainly scope for consolidation. And we've been busy in that regard since our IPO in March, which was very successful. We raised $90 million US on the New York Stock Exchange back in March of last year. We've actually merged with 3 of our peer companies, Ely Gold, Abitibi Royalties, and Golden Valley Royalties, to help vastly expand our royalty portfolio from an initial endowment of 17 royalties now at 191 royalties. And we've recently launched a takeover offer for Elemental Royalties. And I would encourage anybody that's interested in the merits of that deal to look at the filings we've done with the SEC on EDGAR and on our website. So there is still scope for consolidation. We're continuing to look at M&A opportunities to continue to grow our business quickly because scale matters. It drives down the cost of capital, makes us competitive for new royalty opportunities. We're also looking for individual royalty opportunities as well. Last year we bought a package of royalties in northwestern Quebec from an operator called Monarch Royalties. They're restarting an old mine called Beaufort. And so we have growth through multiple dimensions, through M&A, through the acquisition of individual royalty opportunities, and in addition, that royalty generator model that I was talking about earlier on that provides organic growth.
Awesome. Well, I really appreciate the time, David. I actually learned a lot myself. Now, if people want to become more involved or learn more about Gold Royalty Corp, where can they find that info?
Look, I'd like to invite you to visit our website, goldroyalty.com. We're GROY on the New York Stock Exchange American if you're looking for any more information on us. And thank you for your attention this morning.
Before I wrap up the video, I do want to say a huge thank you again to David Garofalo for joining me, talking about Gold Royalty Corp, and also explaining the business model, because I know a lot of people out there, when they look at investing in gold companies, one of the things they're a little apprehensive about is the risk factor. But with a royalty company, you can eliminate some of that risk and also get that potential leverage over the spot price of gold. So I would highly recommend that you do your own due diligence on any company you invest in. If you want some more information about Gold Royalty Corp, there will be a few links down below in the description. And I do want to say a massive thank you so much for watching my video, and I will see you all in the next one. Silver Dragons out.